Now turn to financial stability. The health parameters of banks and NBFCs in India continue to be strong. There has been some recent commentary on the likelihood of stress buildup in a few unsecured loan segments like loans for consumption purposes, microfinance loans, and credit card outstandings. The Reserve Bank is closely monitoring the incoming information and will take measures as may be considered necessary. Banks and NBFCs on their part need to carefully assess their individual exposures in these areas, both in terms of size and quality. Their underwriting standards and post-sanction monitoring have to be robust. Continued attention also needs to be given to potential risks from inoperative deposit accounts, cybersecurity landscape, mule accounts, and a few other factors which we have been stressing and highlighting time and again in the public domain as well as in our interaction with the banks and NBFCs. Now, overall, I would again like to stress that our banking and the NBFC sector, that is the financial sector, remains healthy, resilient, and stable. NBFCs in particular have registered an impressive growth over the last few years. This has resulted in more credit flow to remote and underserved segments, bolstering financial inclusion. While the overall NBFC sector remains healthy, let me re-emphasize, while the overall NBFC sector remains healthy, I have a few messages to certain outliers. First, it is observed that some NBFCs are aggressively pursuing growth without building up sustainable business practices and risk management frameworks, which should be commensurate with the scale and complexity of their portfolio. An imprudent growth at any cost approach would be counterproductive for their own health. Second, driven by significant accretion to their capital from both domestic and overseas sources, and sometimes under pressure from their investors, some NBFCs, including microfinance institutions and housing finance companies, are chasing excessive returns on their equity. While such pursuits are in the domain of the boards and managements of NBFCs, concerns arise when interest rates charged by them become usurious and get combined with unreasonably high processing fees and frivolous penalties. Effect as business targets drive retail credit growth rather than its actual demand. I am not generalizing it for the whole NBFC sector. There are certain NBFCs where it is happening. Bilaterally, we are engaged with them, but I think this is a message which it's important not only for these outliers to keep in mind, but I think this should act as a guidance for the entire sector. Now, the consequent high cost, I was talking about the push effect, that is business targets driving retail growth rather than its actual demand. In that context, I would like to say that the consequent high cost and high indebtedness could pose financial stability risks if not addressed by these NBFCs in time. Third, NBFCs may review their prevailing compensation practices, variable pay, and incentive structures, some of which appear to be purely target-driven in certain NBFCs. Such practices may result in adverse work culture and poor customer service. To sum up, it is important that NBFCs, including MFIs and housing finance companies, follow sustainable business goals, a compliance-first culture, a strong risk management framework, a strict adherence to fair practices code, and a sincere approach to customer grievances. The Reserve Bank is closely monitoring these areas and will not hesitate to take appropriate action if necessary. Self-correction by NBFCs would, however, be the desired option.